All right, welcome back. Now, we just heard from a bear. Now it's a bull's turn. John Herrmann says his models continue to point to improving U.S. labor markets. Maybe that helps explain why he's also upbeat about retail sales. Let's find out. Let's bring in John Herrmann, founder and president of Herrmann Forecasting. So I did just talk to David Tice for a long time. He makes some good arguments about all of this stimulus spending and, you know, questions about growth going forward. You're not worried?
No, I love following Dave Tice on the show. I think it's outstanding. We can go on to some things about that, but anyway, here's the bottom line. In April, we were looking for the stock market to hit 9,000 this year. By June, we had raised our estimates to 9,500. By July, we were at 10,000.
So this
We've hit 10,000.
Doesn't surprise you.
It doesn't surprise us. So we're thinking we're going to go to close to, you know, we think we're going to top 11,000 next year. Basically, the bottom line is our view, to differ from Dave's for a second, our view would be that the economy, you know, went through one of these severe credit crunches in the fourth quarter, first quarter this year. Basically, businesses overreacted to it, slashed everything, overslashed things, and now we're kind of in that rebound phase in conjunction with all the stimulus, monetary and fiscal policy stimulus.
But isn't that why we're seeing growth at this point, John?
No,
it's all
at this point,
those stimulus moves. It's not like it's real growth here.
Okay, well, it is. It's, you know, we're beginning to get the traction on real growth. I mean, we're seeing business capex spending improving in the third quarter, so that's real. That's actually real growth. We saw very decent.
Hiring a lot.
Okay, hold on. We saw very good retail sales in what we call control retail sales, which is what would more or less capture the back to school sales. Those numbers have not failed to predict the outcome for holiday sales, and right now, positive in the third quarter for back to school means positive holiday sales. So we plugged in our numbers for the quarter-on-quarter growth rate,
right.
And when we do that, we come out with positive year-on-year growth. So the consensus is negative year-on-year growth for holiday sales. We're at positive year-on-year growth, and this is a benchmark. So we'll know this number by end of December, early mid-January.
Right. We'll know
right away.
I'm kind of shocked. Hey, but just to balance you out, I want to bring in, because of course we were just talking with David Tice. We have some sound from David. Let's listen to David Tice of Federated Investors.
We think there's another a double dip. We think it could be worse this next time. When the market starts down, that'll be a disillusionment decline.
All right, he's calling for another double dip. He does see another recession coming. You don't buy that.
We're not, right now, we're seeing enough traction that gets us right through the first 6-7 months of next year. So at this point, you're going to have to come up with some kind of reason for the traction to fail in the second half of next year. That would be our clue.
John, what makes you so sure, though, that we've really worked off all of those excesses that brought us to the brink last fall?
Okay, so and from our standpoint, we're going to look at this from the economy base. You know, we're seeing, the housing market has bottomed. Inventories are.
Wait a minute. I just talked to Bob Schiller, tracks the housing market very closely, called the housing downturn correctly before anybody was talking about it. He's not so sure.
Okay, Bob Schiller, I just read a little snippet of him, and he said he was astounded. He said he was looking for home prices to stabilize in 4 years, and he said he was astounded to see the stabilization over the last 4 months. Right,
but he also said those 3 months of increases, he's a little baffled by it.
He's baffled, and he's trying to say that maybe they're due to some seasonal factors and that kind of thing. But bottom line is, we want to really measure this business cycle. So from our standpoint, we say the inventories are being crushed this year, and they will be rebuilt next year. Business earnings productivity is extremely strong. Profit margins are almost at cycle wides at this point. So we look for that to feed through into capex spending next year, into some kind of hiring next year. We're seeing the jobless claims come down, and we're coming into the zone. We keep running this chart, and we keep updating the models. And so that's within 3 months, we should be seeing something on private sector payrolls. Believe it or not, we think they could be positive.
You think that we're going to see? You thought it could happen in September, or as early as September. It didn't happen.
It didn't happen, and we're going to watch this thing. This September number with payrolls could have been a fake out. It could have been, some weird timing early in the month kind of thing.
Why do we have?
We'll know in 2 weeks with the new payroll number.
I know I give you such a hard time, but why then we have a data point like today? Consumer confidence down today. Used consumers fell more than forecast in October. It's a reminder.
Absolutely.
Households are still nervous. They're worried about losing their homes. We had foreclosures, another bad number yesterday. I mean, they're still worried.
It's hitting. You look at some of the foreclosures. It is hitting some pockets that I would call, some of the kind kind of strange pockets in the mortgage market. The mortgage portfolio, if you will, in the United States, very complicated portfolio. We have everything from negative amortization, option arms in there. We ran through the subprimes. We have like this weird collection of loans. They weren't just like a bunch of standard, normal loans, and that, you know, so there's these weird pockets that are suffering, and they continue to suffer. But
John, you track all these data points. The Fed obviously has access to tons and tons of data as well. If they're so optimistic, as Joe Saluzzi of Themis Trading, you know, reminds us, if everything is so good, why are they keeping interest rates at zero?
You know, the thing is this. The thing is, we are still in this repair process. Like you said, we have yet to put a peak in the unemployment rate. We have the unemployment rate rising up through the first quarter of this year.
Right.
So we have yet to put that in. We have yet to produce the first positive gain in payrolls. Then, you know, these are the things that say keep the stimulus going until we get some of the additional traction.
And bottom line, something you talked about, retail sales, you're upbeat, and you expect it could be good for holiday sales. So we'll see if that happens.
We'll know soon.
John, always good to get some time with you. We always enjoy it. John Herrmann of Herrmann Forecasting.